All right, buckle up, America. If you thought your grocery bill was high, I've got some news that might make your wallet wince even more. We just got a fresh report on inflation, and it's sending a clear warning. Prices are on the rise, and it's heading straight for your everyday shopping cart. Putting it into perspective, this isn't just about what you pay at the store. It's about big shifts in our economy that could impact everything from your job to your investments. Let's break down what's happening. First up, let's talk about the Producer Price Index, or PPI. Think of it as the price tag on the goods and services that businesses sell to each other before they ever get to you, the end consumer. It's a key indicator because if businesses are paying more, you can bet those costs are eventually going to trickle down to what you pay. And for July, this index jumped a whopping almost 1% in just 1 month. That's a huge surge, the biggest monthly increase we've seen in over 3 years. Annually, these wholesale prices are up over 3%. Economists were expecting a much smaller rise, so this was a major unwelcome surprise. What drove this? It hit both goods and services. A big chunk came from rising service prices, which jumped over 1%. This included things like machinery and equipment wholesaling, where prices surged almost 4%. Even financial services saw significant increases. But it's not just services. On the goods side, prices posted their biggest gain since January. And for many of us, the most noticeable hit might be at the supermarket. Get this, the wholesale cost of fresh and dry vegetables skyrocketed almost 40% in July alone. Additional specifics, beef prices jumped over 1% and eggs were up over 7%. Broader impact, tools and hardware also saw price increases. While some items like appliances actually saw price drops, the overall picture for wholesale goods is definitely showing heat. This PPI report is basically yelling at us that higher costs are simmering just beneath the surface, about to boil over for consumers. Now, let's peel back another layer. A major factor that many economists are pointing to behind these surging wholesale prices, it's President Trump's tariffs. These are essentially taxes on imported goods, meaning American businesses importing them pay more upfront. The White House has argued these tariffs wouldn't hurt Americans, claiming foreign companies would foot the bill. But the latest numbers paint a very different picture. Economists say businesses have been trying to absorb these higher costs, perhaps by cutting into their profit margins or stocking up on goods. But that's not sustainable. One analysis suggests that while consumers have only paid about a fifth of the tariff costs so far, that share could jump to as much as 2/3 by the year's end. This means the higher prices producers are facing are very likely to show up in your everyday purchases soon, from furniture and auto parts to even apparel. It's a hidden inflation pipeline, and it's getting ready to burst. This brings us to the Federal Reserve, our central bank. Their job is tricky: keep prices stable, aiming for 2% annual inflation, and keep employment high. For months, the Fed has held interest rates steady, worried about these tariffs igniting inflation. Just a couple of days ago, a separate report on consumer prices showed things were a bit calmer, with overall consumer prices rising about 2.5% annually. This report had fueled widespread optimism that the Fed was almost guaranteed to cut interest rates next month. But this new wholesale inflation report, it's thrown a huge wrench into those hopes. While most traders still expect a quarter-point rate cut next month, the odds have slipped, and the chance of a larger half-point rate cut has now dropped to 0. Fed officials are feeling the pressure. Some, like San Francisco Fed President Mary Daly, say a big cut isn't justified by the labor market's strength. On the other hand, St. Louis Fed President Alberto Malusiman, while not committing to a cut, has revised his outlook for inflation lower and labor market risks higher, but still calls a half-point cut unsupported. So
they're stuck between fighting rising prices and boosting jobs. It's a real balancing act, and the stakes are incredibly high for the entire economy. So, how did Wall Street react to all this mixed economic news? Not great. Stocks mostly stumbled. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all dipped even after hitting record highs just a day earlier. Smaller company stocks, often hit hardest by higher interest rates because their borrowing costs become more expensive, took a significant tumble, falling almost 2%. Currencies and bonds, the dollar got stronger, and bond yields, which move opposite to bond prices, went higher, signaling inflation concerns. And for the crypto world, Bitcoin and Ether, two of the largest cryptocurrencies, took a noticeable hit. Bitcoin tumbled thousands of dollars, falling below $119,000 after reaching a record high above $124,000 just the night before. Ether also plunged several percent. This crypto slide triggered over $1 billion in liquidations for traders who had bet on higher prices. While some analysts are calling this a healthy pullback, it clearly shows how sensitive these markets are to major economic news like inflation and shifting interest rate expectations. Even gold and silver saw sell-offs as higher interest rates can make non-interest-bearing assets less attractive. Adding another layer of complexity is the ongoing drama surrounding the government's official data. The president recently fired Erica Mentorfer, the head of the Bureau of Labor Statistics, the very agency that publishes these critical inflation and jobs reports. He claimed, without any evidence, that the data was rigged. He's since nominated a new person, an economist who has been a harsh critic of the BLS, and has even floated the controversial idea of suspending the monthly jobs report, saying its methodology needs adjustment. This has raised serious concerns among many economists and experts about the independence and accuracy of the economic numbers we all rely on to understand the economy. It's a reminder that even the data itself can become a point of contention. So, what does all this mean for you as an American consumer? The message is pretty clear. Expect to see those higher wholesale costs start to appear on store shelves very soon. The prices of many goods, from groceries to appliances and even services, could continue to creep up in the coming months. The Federal Reserve will be watching all the incoming data very closely, particularly the August jobs report and their preferred inflation gauge. Their next move on interest rates will depend heavily on what those reports show. For now, it looks like inflation is still a significant force to be reckoned with, and it's coming your way, potentially making your daily expenses more costly. That's the latest on inflation and what it means for your money. It's a complex picture, but staying informed is your best defense. If you found this breakdown helpful, please give this video a big thumbs up. It really helps the channel. Don't forget to subscribe for more economic updates that actually explain what's happening to your wallet. And make sure to hit that notification bell so you don't miss any of our videos. Thanks for watching, and I'll see you in the next one.